Hello, everyone, and welcome to the latest LPL Market Signals. Jeff Bookbinder here, your host for this week with my friend and colleague, Quincy Crosby. Quincy, thanks for joining. It is very windy and very rainy here in Boston. I hear it's similar down there where you are.
Windy and sunny, cold.
Oh, well, that's better. Not the cold part, but at least you got some sun. We have no sun. In fact, this is really strange. My kids, I've heard about early release day. At school, they had late release day. I've never heard of this before, where the principal kept the district in school for an extra hour to wait for the winds to die down and for the commute to be safer. So how about that one? That's new to me. Have you ever experienced that before?
Like it.
You like it?
I like it, yeah.
All right, smart move. Smart move,
Yeah.
Safety first. All right, so here we'll look at these lovely disclosures, then we'll move into the agenda for this week. We got a lot of stock market gains to talk about. New all-time high for the Dow, the S&P 500, as we're recording this on Monday, December 18th at about 2 p.m. Eastern. The S&P is about 1% from an all-time high. So we're close, got about 45 points or so to go. But the Dow got there already. Why did the Dow do that? Because of the Fed pivot, which we'll talk about. We're also going to look at commodities this week. So, Quincy, you have a great global perspective. So, whenever I do this podcast with you, I want to talk about what's going on globally. So certainly we can look at the commodity markets and get some understanding of what the markets are pricing in terms of global growth. And then the week ahead, of course, the Fed's preferred inflation measure. We talk about it every time that's on the docket. Inflation's become a little bit less important because we got the pivot. But nonetheless, I think that's the most important economic data point this week. And then the Bank of Japan is certainly the most important thing we're going to get from a central bank this week. So interested in hearing your thoughts on the BOJ, Quincy. So let's start with our market recap. We didn't do this last week because we just went through the LPL outlook for 2024. As a reminder for those who haven't seen it yet, the LPL market outlook for 2024 is out on LPL.com. Actually, along with our new blog. We have a new blog site on LPL.com, which was migrated over from LPLResearch.com, which is very exciting. It looks a lot better. So thanks to the folks who did that for us. So we're back to kind of our normal agenda, normal routine. So this is the market performance recap. And you see here, the seventh straight week for the S&P 500 higher, up 2.5%. The Russell 2000 has gone from a 52-week low to a 52-week high in a very short amount of time. Basically, I think it's around 5 weeks, 5-6 weeks, which is about as fast as that ever happens. So clearly this market is broadening out, and it's not just about the magnificent seven. Also worth noting, the cyclical sectors did better than the defensives in general. That is signaling solid economic growth ahead. In fact, I saw a study over the weekend from Goldman Sachs that basically ties the correlation between cyclicals relative to defensives and GDP growth. And it's saying 3% right now, GDP growth, which of course is really strong. We probably won't do that in Q4, but certainly we wouldn't be surprised to see 2. So very cyclical and sort of risk-loving type of intramarket performance here. And, we had gains overseas. We had, not totally across the board, but certainly in most of the key markets globally. The dollar's starting to weaken. That makes sense when the Fed is presumed closer to a cut than a lot of these other markets outside the U.S. Bond returns were really strong, up over 2%. We're up 5% year to date on the Bloomberg aggregate bond index. We were at negative returns for bonds not too long ago. So we basically made our year in bonds off of just the last, month or so with this huge rally as rates have come down in recognition that the Fed is done. There you see the dollar weakness in the bottom right-hand corner here, down 1.5% on the week. That certainly helped not only international stocks post gains, but also commodities. Energy finally bounced. Industrial metals were quite strong, and precious metals solid as well, up between 2 and 5% across all the major commodities. So we'll talk more about that in a minute. So here's the S&P 500. So Quincy, you know, the index is overbought, right? I mean, frankly, most of its components are overbought. You see that in the bottom panel here. 40% of the S&P in overbought territory, over 70% above a 20-day high. The RSI of the index is right around 70. That is overbought territory. So I think the question is, are we going to drift higher consistent with seasonality, or do you think this market needs to pull back and maybe over the next month we'll end up lower?
Well, I certainly think that markets typically need to consolidate gains, pause, and then get ready for the next rally. But markets that have a very strong underpinning, such as this market, can defy the need to burn off some of that froth. A strong market does defy the same way in an oversold market. We always say an oversold market is due for a bounce. But if that oversold market has reasons to be oversold, it'll continue. We're seeing this on the other side of the equation. And every time we thought the market was going to pause, it looked as if it was going to pause. Typically, the 10-year yield would inch lower, and then the market will get another bounce higher. But it will happen. The market does need to pull back, and it will pull back. It's not if, it's when, but it will be just a pullback.
Yeah, the fundamentals of this market are still pretty good. So I would agree with that. If we pull back, we're not going to pull back dramatically. You have good breadth now, and you have the opportunity for the S&P 493 to do well, right? We've been just talking about those 7 stocks all year. Well, here's the chance, and we saw it in small caps, right? Here's the chance for the rest of the market to start doing some work and maybe can lift the overall index, even if that Magnificent Seven doesn't do too much. So let's turn to the 10-year yield. I mean, this, of course, is the reason why stocks are rallying, right? Or at least it's tied to the reason why the dovish Fed and falling inflation. We just lowered our 10-year yield target for year-end 2024. It's 375 to 475. You can see on this chart, we're a little under 4. So, there's certainly some downside in our view. I mean, the momentum to the downside has been quite strong. So we wouldn't be surprised if we go a little lower, but the returns from here for bonds are probably going to be a little bit more modest, certainly than we've seen. You're going to see, we probably see some resistance below 375. But if we do get down below 375, then maybe you could look at 3.3 as support. That would be quite a move from 5% not too long ago. So rates are nearing oversold levels and are probably going to find their footing here fairly soon. So let's turn to the Fed. Speaking of rates, so Quincy, we got what everybody called a dovish pivot, and the dot plots told us 3 cuts. I think most people that I've seen forecasts for are looking for 4. The market is pricing in, it looks like 5 next year, maybe even 6, right, to get us a little below 4%. What do you think? Is that too aggressive here? Do you think 3 is the right expectation, and when do you think the cuts start?
Well, I think that if you have a so-called soft landing, and it looks as if now for the fourth quarter, we're back above 2% in terms of for the data up until this point. So we've moved up from about 1.2% to go above 2%. It'll be hard to understand why the Fed would need to cut rates, say, in March or April. I already saw the Fed funds futures market pulled back on its forecast for a rate cut in March, pulled it back. And the reason for that is there's been some pushback from the Federal Reserve speakers in an orchestrated attempt to get the market to understand that the Fed is not in the mood right now to discuss rate cuts. That came from the head of the New York Fed, John Williams. It was backed up, interestingly, by Bostic, head of the Atlanta Fed, who tends to be much more dovish than the average dove on the Federal Open Market Committee. And then Loretta Mester made a case also, spoke to the Financial Times saying, I don't think so. So, this is orchestrated. It is the Fed saying, basically, we want some quote unquote optionality, as they like to say. If they have to raise rates, they don't want to. They probably think they don't have to, but it's a just in case. And Chairman Powell also said at the press conference early on, actually, I think it was the second questioner at that press conference. He said, look, I just want to say we're not declaring victory. We're not declaring victory. We've done very well. It's moving in the right direction, but we have to make sure that it continues to move in that direction. They don't want any surprises, and they also don't want to repeat what happened in the 70s. And also, you have to argue for Volcker. He raised rates, cut rates, and then later on he was forced to raise rates again. I think they want to go slow, and I think also they're prepared at this point, Jeff, to say, look, we're not going to be rushing towards 2%. We don't want to damage the economy in order to get to 2% quickly, as long as it is moving in the right direction and that the last mile is moving closer in that direction. In other words, the untangling of the super core. We'll find out this Friday. We'll get the personal consumption's expenditure index. So the market, by the way, in this market today is saying, oh, really? We're not really sure we believe you anyway. You'll wind up having to cut rates. And, if something breaks, they're going to provide liquidity. They are going to come in quickly and provide liquidity by cutting rates. There's no doubt about it. But the question is, what else would get them to cut rates? And that may be that at some point, inflation comes down to a level that happens not to be commensurate with where the rates are. And then they will cut as well. But that's not going to be in March unless something goes wrong.
Yeah, the odds of something breaking have certainly come down with this move lower in the 10-year yield and intermediate rates along with it. So they might pull off what many thought was impossible, frankly. Normally the playbook is buy the pause and sell the cuts. In this case, it's possible that, we don't get a cut until the second half of the year. And, by that time, the market kind of heats up a little bit again. We get through a little economic soft patch, maybe.
Yeah.
And then they're, looking at maybe hiking again next year. That wouldn't be our base case, certainly. But, look what happened in the 90s, right? You had a soft landing and then you overheated later. We'll see. But right now, let's just focus on the fact that the pause is here. The market really likes that. And, frankly, I wouldn't get too caught up on whether we get a cut in, May or June, or maybe in a little bit after that. So, and March seems too soon. I agree. So let's turn to commodities. So Quincy, the outlook, we had a commodity chart where we compared this commodity cycle to the 2001 to 2008 cycle. That was driven more by China. This time China's working against the cycle, not for the cycle, right? So, this is just the broad Bloomberg commodity index, so it includes a lot more than oil, but it has come down, and it's now behind its pace from that prior decade. And frankly, given the growth outlook in China, which I know you'll comment on in a bit here, maybe it goes much lower. So commodities outlook is not unequivocally positive here. A quick look at oil. I know you've got some thoughts here, Quincy. We have a little bit of a bounce. I titled this chart starting to get its footing. The 65 to 67 kind of range has a lot of support technically, and we just bounced above this, sort of upward sloping trend line to get, back into the low 70s. I'll say this, our bias is oil goes higher. And certainly the geopolitics are pointing in that direction. Seasonality is pointing in that direction as well. It's turning more positive. But there's a lot of headwinds here, right? I mean, you have U.S. oil production at a record, Quincy, and you have a lot of technical resistance, right? Having essentially chopped our way down from 93 to 70, right? It's not going to be a straight line up, I think. In fact, maybe it takes, they say that a lot of these commodities take the elevator down and the escalator up. I think we're in an escalator up situation here with oil. What do you think?
Well, we saw this playbook some months ago when oil prices came down quite dramatically on the back of recession fears, when that was very prominent in the headlines. And it didn't matter about cuts in production back then, and the oil prices continue to edge lower. Suddenly, you have that changing, but as you pointed out, the U.S. frackers are coming in, and we've got record production in the U.S. But a couple of technicals helped put a kind of a underpinning last week on prices, and that was the stockpiles, crude stockpiles in the U.S. were lower than expectations, which is when you want the price to go up. That was a good catalyst for the price to go up. The other thing is, and I have to add something about whether or not the market thinks oil prices are going to go up. Take a look at the Saudi market today. That's all oil. That all oil all the time. It's up. At least it was up earlier on their cycle. The other thing that is happening, and this is important, and that happens to be the Iranian surrogate. They've got a number of surrogates. They deny it, but nonetheless, the Yemen-based Houthis are out there in the Red Sea targeting the tankers. Why this is different now this week? The question is, where are the tankers going to go? And therefore, it makes oil more expensive because they're going to have to go around, and that takes longer. It's more expensive. They burn more oil doing that. And then there's another question as far as that's concerned. What is the U.S. going to do? This is important because the U.S. clearly doesn't want to be brought into anything that pushes this conflict away from the so-called contained conflict with Israel and Hamas. It would push the U.S. closer into a quagmire with Iran, which Iran may want, actually. But the point is, you see oil prices going up as soon as this became yet another story. The big integrated names are having their ships go around or not going. This again, anytime you disrupt the pattern or the supply of oil, doesn't matter what it is, a hurricane, people striking, or something like this, prices climb higher. So that's what we see. But the bigger question is, how much more does the U.S. take? Remember, U.S. troops have been targeted. A couple of our ships were targeted. At some point, the U.S. may just decide they're going to answer back. And if they do, they're going to win, because if you start sending in U.S. support, they're not going in there to just be a cruise line. They're going to go in there to make sure they send a message. The question is, does the U.S. do that? And if they do, when? How much more does the U.S. take from these surrogates for Iran? Of course, I just want to point this out. Iran denies it, but the history dictates that they are the surrogates for Iran. I just want to point out, too, they have gone after Saudi targets as well, and that has placed the Saudis in the line of conflict with them, the Houthis, and also, therefore, Iran. So it gets to be quite complicated. But oil prices climbing higher. And I just want to point out the U.S., again, at 13.24 billion barrels of oil a day. And the expectations are we are going to come out with about another 550,000 barrels of oil a day next year in 2024. There's no stopping. I want to add here to something that I think may be interesting. Folks may remember this. Before it was OPEC Plus, it's just called OPEC. We were producing so much oil. It was almost a change in our culture in the U.S., where we were becoming energy independent, completely energy independent. The Saudis did not appreciate this. And what they did was they flooded the market with oil. They just flooded it with oil, thinking that what would happen is the U.S. shale producers would just back out. They would just back out because the price point was just not enough for them to make any money. Well, what it did was it caused chaos in the entire energy industry and the energy complex and prices for a long time. I only mention this because there are many who believe that the Saudis could pull something like that again. Our view is that they probably won't because of the chaos that would ensue. But that said, they want to come out and have a unified view from OPEC Plus in saying we are going to cut production. It's not going to be voluntary. It is going to be solid. And that is what they've been lobbying for. They're working on it. And we'll see if they actually can actually forge such an agreement.
Yeah, we've been saying all along that, well, not all along, but certainly since October 7th, that the key to oil prices is whether the conflict between Israel and Hamas gets wider. And if you potentially disrupt oil production coming out of Iran, then you have a formula for higher oil. So that's what we'll have to continue to watch. This chart looks a little better. This is copper. We talk about Dr. Copper because it's a global barometer of economic growth. So, maybe you could read this to mean that the economic growth outlook in China is bottoming, right? Maybe expectations have bottomed. I mean, the economy is not accelerating, but maybe the expectations are troughing. What do you think, Quincy?
Manufacturing, industrial production surprised to the upside. I mean, that is the official data that came out. And that whenever you see that, you'll see some of the industrial metals also move higher. But the big expectation is, and again, hope springs eternal. And that is that the authorities at their so-called third plenum, that is the big meeting. That is the one that the world watches. It is where they come out with their 5-year plan, all of their goals. What's happened is they haven't had it. They were supposed to have it in 2024. They typically have it October, November, or December. So far, no one knows when it's going to be, which is a big change. However, the expectations are that when they do have it, there will be more help coming from the fiscal side of the equation, as opposed to the monetary side, which has been seen as tinkering, trying to help the beleaguered, almost illiquid property developers. This is one of the things that's holding them back, the debt that is mired in the property developers, which happens to be a large portion of the Chinese economy. The hope is also that perhaps they introduce, get this, a Western style way to alleviate the pain, the way that we've done in the US, the way that other countries have also gotten rid of bad debt. You create the bad bank, or we call it the sick bank, and then you move all of that debt and you push it over so that you clean out the entity, and then you monetize what's in that bad bank. The goal, and this is, I should point this out, no one is saying it's going to happen, but let me put it this way. The Chinese authorities know that this is a viable path towards cleaning this up, and they know they have to clean it up. That said, the hope is that they will come out with a significant fiscal package. By the way, that most likely it will be infrastructure spending of some sort, perhaps water treatment throughout the country. That would require building, and of course, that is good for the industrial metals. Remember, too, that they are leaders in EV, electric vehicles, and copper is used in that. And, they're going to push that production. One thing I just want to add about what the expectations for China, and when you mentioned the early part of the century where commodity prices just went through the roof, Most likely, this stage for China is where they want to move up the scale, up the value added scale, which is very normal for countries that are emerging from the emerging market status where it's double digit growth. They want high technology. They want manufacturing that is much more suited for a technological infrastructure, high end. And that kind of growth is not double digit. That's usually even below 5%. Most people expect that is what we should see from China. But in terms of commodities, they probably will have an announcement that could push commodity prices higher. They're not deviating from their goal to be the world leader in EV.
Yeah, EV sales been cooling a bit in the US, so it's really more China, I think, that's driving this this copper move.
For sure.
Yeah. So the LPL Research house view is neutral on industrial metals, neutral precious metals, and
look at gold.
And overweight. Yeah. Gold's had a nice run. We sold into strength, I guess you could say. And then right now energy is our preferred commodity, so we'll see what happens, but I think oil has nice upside here, at least in the short term. So let's conclude here with some geopolitical topics. Quincy, you certainly are well versed on all of these. So what should investors be thinking about, as 2024 outlooks come out? And most forecasts are between, I don't know, 4,800 and 5,100 on the S&P. That's what I've seen. Anyway, we're kind of right in the middle of that. We all know inflation's a risk and rising rates are a risk that we can't totally dismiss. But how about the geopolitical risks? What do you think could potentially derail us next year?
Well, I mean, you're going to probably have an issue with Taiwan. Let me put it this way. President Xi is going to have Taiwan join Beijing. I mean, it's one China, and they're not going to deviate from that. The question is, how do they deliver that? And if they can't deliver it by having pro-Beijing officials in place to make it easier, they're going to go in and they're going to do whatever they need to do to get them to capitulate. The question has always been not if, but when would they do it? And some of the analysts in the U.S. have said latter part of 2025 or even 2027. By the way, most have now pushed it closer. And the view is this: if you wanted to do something like that, you've got an economy that is slowing, that's sluggish. Consumer spending is down. Consumer confidence is down in China. What about your adversary, your main adversary, the U.S.? Well, why didn't you ask that question? The U.S. is focused on the Middle East, focused on Putin and Ukraine, and you have a political season coming up. That happens to be a very good time to do what you want to do. The question is, will they? The other question about it, I want to add this angle to it, and that is that there has been a tremendous amount of purges in China, particularly in the military, the foreign affairs community in China, in the economic sphere in China, purges across the board. And it suggests that President Xi Jinping is becoming more and more paranoid. Very often mistakes are made. And that's the worry about perhaps it happens sooner rather than later. That's the case that's being made, because once a leader becomes paranoid, if in fact that's what he is, they tend to go deeper and deeper and try to show the world they're not paranoid and make mistakes. So I'm just throwing that out there. That is a concern about Taiwan. And the other aspect to it, by the way, is there is an expectation that our allies are not going to join the U.S. in any material way regarding Taiwan. In other words, if it's a military conflict, the expectations are they do not want to destroy their relationship with China. Sanctions work, but only up to a point. China is much more independent, if you will, if for their economy to function. They have commodities, they've got minerals, and they have a very large workforce. So that is a concern. The other concern is the Middle East. This is a concern, and the Middle East is not going away. And you can see this constant pushing on the United States. The question again is, does the U.S. turn this into a larger conflict? Obviously, they don't want to. Obviously, Biden does not want to. But it may reach the point where by not doing anything, they actually invite more trouble, more conflict. Then the last one has to do with Israel and Hamas. The Biden administration is being pushed in both directions. For the election, Michigan is extremely important. Many have said, well, he's lost Michigan. The other issue is, how far Israel is going to go. The president has been pushing to have Israel basically wind things up. There's an old saying in the military is that when you are going after your adversary, what you don't want is a soft surgeon. You don't want a surgeon who is going to go easy on you. And that is the other side of this equation as to whether or not the Israelis just give up now, or do they go the extra miles, almost literally, to reach their goals.
Yeah, they're saying that they've entered a new phase, or I think that's their words, as well as Biden's words, a new phase that's maybe going to be more surgical. But they're certainly not going to, respond to calls for a ceasefire until they're ready. And even when they're ready, it's not going to be a ceasefire. It's going to be more of a targeted search for terrorists, and that's going to take them outside of Gaza, certainly. So, yeah, and I agree. You can't totally dismiss the Middle East. I mean, history tells you, and we've showed this before on this podcast, that the stock market tends to look past these types of events.
Of course, yeah.
As long as you're not in recession, right? As long as it's not a major financial crisis, and right now we're not experiencing either of those things, then the stock market should withstand a lot of turmoil in the Middle East. But when you take oil prices higher, when you have the U.S. and Iran potentially, we hope not, but engaged, right, with one another, then that's a whole different story, because then you could potentially see $100 oil, which obviously has economic impact and involve the U.S. military. That's we're a long way from that, and we hope we never get there, but that's certainly more of an economic event. So economy's in good shape. The fundamentals of corporate America are in good shape. The cause of this soft patch, malaise, whatever you want to call what happened in 2021, is largely gone, right? We don't really have a major inflation problem. Unfortunately, we're at higher prices. Sure, you're growing modestly off of, compared to the price increases of the last couple of years, but we still are at higher price levels. So inflation, is maybe from the Fed's perspective, the battle is largely won, but we're still paying more for goods, a lot more, frankly, than we were paying a few years ago. And so that the threat of putting higher oil prices on top of that, although they've been going the other direction lately, prices at the pump are, $2 and change in a lot of places. But there's still that risk out there that we have to monitor. So we'll just keep monitoring all of this. Russia, Ukraine, we have to monitor too. Again, it's the same situation in the sense that if it remains contained, it's unlikely to affect the U.S. economy, right? And that's, or corporate profits. And in that event, if it's contained, you're probably going to see stocks continue to go higher, and rates stay where they are. So still a pretty good backdrop, but some risks we have to watch. So not the most upbeat way to end, Quincy. So let's talk about the week ahead real quick, and then we'll end. Right, this is a more positive message. We'll get more good inflation data. The core PCE, the people that track the individual components of this and take the CPI and convert it into PCE, are saying it's going to be up like 0.13 month over month on the core, something like that. Right. So I think there's a little bit of downside to consensus expectations, and the PCE data, the Fed's preferred inflation measure, will continue to support the Fed pivot. I also highlighted sentiment. You mentioned, Quincy, a couple of times, consumer confidence, I guess with regard to China, but consumer confidence really does matter. It's important for consumer spending, especially during the holidays. So I just flagged that. And then the University of Michigan consumer inflation expectations survey, I think is really interesting. That's moved all over the place, but the last tick was down a lot. So, right, we went basically from 4 to 3 in one reading, and now hopefully we'll stay where we are or go lower. So I think that'll be important to watch. And then housing data too. Anything, Quincy, anything else you'd highlight here before we end?
Well, I want to mention that we're going to have the Philadelphia manufacturing report come out. And I only mention this because it has a very strong positive correlation with the manufacturing heartland in the U.S. And the reason I mention it is that the consensus estimates, while down in negative territory, bottoming markedly. Remember one thing about the market and investors, they like to see less bad news. So if it's less bad news, that's very good news. It may not sound scientific, but folks watch to see if bad news sort of eases up. And that's what we're looking for in that Philadelphia Fed survey that comes out this week. That would be important. Maybe it has to do with the United Auto Workers strike over and orders coming in, but it'll be important. Manufacturing is what is it, about 10, 11% of our economy, but it is important, and we want to see it start to make that turn. We'll be looking for new orders. We'll be looking for hiring expectations and prices paid.
Absolutely. And then the BOJ this week, there's been a lot of speculation that they're going to, at least hint at tightening, probably not tighten. So we'll have to watch that. They come out with their announcement tomorrow, Tuesday. So you'll know what they said by the time you listen to this. So probably not going to be any surprises because the market's been anticipating this for quite some time. But the BOJ officials have essentially telegraphed that they're not going to make the move at this meeting. Is that fair, Quincy?
Well, they were a little bit vague. They do try to they go after the hedge funds. I mean, they are constantly being attacked. Their yen, for example, is constantly under attack, not by the Houthis, but by the hedge funds. And they try very hard to circumvent that. And that's why they don't want to give it away. The one thing I do want to say about when they make the decision, maybe it'll be that they move yield curve control a little bit more, right? Lift it a little bit more and not pull the Band-Aid off. But they want to do it when global markets are fairly sound. And I think, at least the biggest market, the United States, it is in good shape.
No doubt. That might mean it's a good time. But some people talk about how the BOJ surprises, but I think raising rates tomorrow would be too much of a surprise. So
not raising rates, just the yield curve.
Right, just the yield curve control range. But even that, they already basically
did it a little bit,
guided to higher range. So I don't think that range is going up either. We'll see. But the yen is rallying in anticipation.
Yes.
That'll be important to watch this week because higher rates in Japan do translate into higher rates in the U.S. So we'll end on that note. So thanks, Quincy, for joining. Thanks, everybody, for joining as well for another LPL Market Signals. We're going to be off next week for Christmas holiday, but we will be back with you. I guess this is our last one of the year, right? We will be back with you after New Year. So I'll wish everybody a joyous holiday season. Safe, happy, healthy holiday, and we'll see you next year. Take care, everybody.
Thank you so much. Thank you.